wanted to bring up and start with butterflies, because considering, let's think about this. This is my first presentation to options play. I jump right in with a butterfly, but September and October, I like to do butterflies in the VIX index. I like to do butterflies in the SPX. And in particular, in September and October, I'm usually bearish with the trades that I'm doing. So the platform right at this moment doesn't support the SPX, but to me, the SPX is a cash settled index. It has daily expirations, 0 DTE options, and it's big. So you can go wide with your butterflies, and there's some premium in it because it's big. And so to me, I really like the SPX. The NDX is too much. The SPY is, a tenth of the value. So a 20-point wide butterfly in the SPY is only 2 points wide. I'm sorry, a 20-point wide butterfly in the SP would only be 2 points wide in the SPY. And that changes the pricing dynamics. That's a very, very tight butterfly. Even though you could do 10 of them, right? Because it's a tenth of the value, it's still, the pricing dynamics are different. And that, I'll leave that for a different day. So this is my favorite underlying to do the SPX in, and that's what we're going to roll with. Okay, so I put this whole example together today. Let's hope I got all the math right. But I did this today, so we're using live quotes. Well, the VIX trade that I put on at the end of September is doing pretty well. The VIX is now at 2055. And like I said, if you're doing butterflies, and yeah, I'm looking at the Q&A. I apologize, I got distracted. Okay, and if I look at the modified put butterfly, the SPX, when I did this, was probably this afternoon when I grabbed the quotes. The SPX was at 56.8963. Markets were moving. I tried to screenshot the quotes, but expiration is 5 days away. Now, this is a Wednesday expiration. I'd rather do this during the week. I don't necessarily want the weekend into this trade because we all know that Mondays in October, well, I don't know if we all know that, but in general, if there's been a big downturn in the marketplace, it's usually a Monday in October after a long weekend. So I prefer to do, I don't mind doing 5 days. So you do it on a Monday, take it off on a Friday, but I did it as of today. So I went 5 days out, which is a Wednesday, and we're looking at the October, well, today is October 3rd. So we're looking at the October 9th expiration. All right, shoot, I wrote that 3rd. So this is the 9th. Today's date is the 3rd. So it's 5 days away. So you got to keep that in mind. So here we go. Buy one SP October 9th expiration, 56.85 put. That was trading at these prices, and the prices matter. So I didn't just say this is the net debit. But if we put this trade on, this is a modified put butterfly. This is the profit and loss graph that we're talking about. How did we modify it? Well, the long put spread that we talked about is 56.85 down to 56.60. That's 25 points. Now, on the short put spread, that goes 56.60 down to 56.40. That's 20 points wide. Now, what does that do? The short put spread brings in the credit. So, by not going further down to the 56.35, by not going 25 points, we don't bring in as much of a credit. Now, this is a midpoint fill, and in the the markets are really moving, but in the SP, you're looking for a midpoint fill. The markets are artificially wide. I used to work at the Chicago Board Option Exchange where they trade the SPX, and you get really good markets. There's a lot of people that make markets in the S&P 500 index. So I would want to trade somewhere towards a midpoint. Now, so here's our max risk, like I mentioned. Our break even, now here's what's interesting compared to a standard butterfly. Where do we break even at? Well, there's instead of 2 break evens, you only got 1, right? Because down here we're profitable. So that is this strike minus that net debit of 305, I guess I would point right here. And it's 56.81.95. So if we hold it all the way to expiration, which very rarely do with a butterfly, but if that did happen, this is where our break-even point would be at. Okay, so everybody know what to do if the market goes down in this instance, right? That's simple. If the market goes down to 56.60 and the market was at 56.89, well, I want to get out of this trade. And I do want to emphasize this before I move on to the next point is, if I'm putting this on for $3, I'm not thinking I'm going to make $22 on this trade. And if you do, which I've always used this phrase, you should get the stupid award for doing that, because you should have been out of the trade a lot sooner. If you rode all the way to expiration and you got lucky enough that the stock or that the SPX or the index stopped at 56.60, well, you should have been out a lot sooner than that, right? Because you shouldn't have taken on that risk. So if I'm doing a trade that's got 25 points is the width of the spread here, and that's the max upside minus the debit, of course. If I can double on this trade, I'm definitely going to get out. And in this instance, if it's a $3 trade and it happened tomorrow and I was up $1, well, yeah, I'd probably get out of the trade. If I'm closer to the expiration, 5 days away, and I make it to Monday, well, maybe I'm gonna shoot for a double on this trade. But a double is very good when you're doing butterflies. You pay 3, you sell it for 6. That's a good trade. Have realistic expectations when you're doing these trades. Okay, and I always do it 1 by 2 by 1 to try to make the math simple. You can apply how many contracts you would want to do, and I'll leave the last little tidbit at this.